Jay, I do want to zoom out in a moment and talk about macro items and the Fed. But first, I do want to get your take on this uptick in deal activity and sort of how investors should be thinking about it. Is there a way for them to play it, or is there a message maybe that all these deals are sort of sending market participants?
Thanks, Julie and Josh, for having me on again. Well, we've been bullish for about 6 months on this year for investment banking activity. And the primary indicator for all investment banking activity, not just M&A, but also offerings. Offerings have been strong as well this year. You had great data on M&A, but also particularly on the credit side, very, very strong. And really low volatility. It doesn't have to be rock bottom low, but below 20. That sets us up well for more M&A and equity offerings because management teams want to have successful deals. So they don't want to go into a crashing market. They don't want to misprice deals. And also the buy side, we're on the buy side. We don't want to take down deals that might crack the next day because the market's unhinging. So I would look to low volatility. So we are very bullish about the investment banking market. And we think that's very, very positive for a lot of the money center banks.
Interesting. So positive for the banks. And do you think that there are positive implications for the market overall, that there's this level of confidence and not just that these are going to be good investments, but also that there is going to be a level of stability perhaps in rates this year or predictability? Or are these defensive moves because of the lack of predictability?
Well, I think in terms of corporations, they're satisfied with no more hikes. They can operate into this environment, particularly in the US, because we have a very strong economy. And there's really little debate as to whether we'll have cuts. And I don't think it might matter to me and stock traders where we have 4 cuts or 3 cuts or 2 cuts, but they're comfortable that there's going to be global cuts. We're much more confident about Europe. We're predicting June for Europe. So we think that's a perfect environment for corporations to raise capital and also pursue their consolidation objectives.
And Jay, let's stick with the Fed and their rate hiking cycle here, Jay. Just interested to get your take. Inflation may be cooling, Jay, but maybe it's slower than a lot of investors expected. When do you expect the Fed to start cutting, Jay? Is it June, or is it later in the back half of the year? And how does that timeline kind of impact and influence how you want to put money to work?
Thanks, Josh. Well, we're quite bearish about the Fed rate cuts. We're projecting August, which I haven't heard, and we are short in our hedge fund, short Fed fund futures up until August. So we have a bet on that as well. But the reason for that is not because we believe inflation's accelerating, but unfortunately in the US, we have a lot of very strange methods for estimating inflation. Everybody knows about the archaic shelter calculation. What they haven't focused on is we had an annualized 30% increase in financial services inflation, which, from my perspective, I wish that were true. But we didn't raise our rates. But what happens is when the stock market rallies, that gets counted as inflation. So we think that PCE is going to print at 0.5. In other words, not roll down at all. So not go down year over year. We think the Fed needs to get to 2.5. That could take this 6 months. So based on that, you should just sell the market. As you were kind of indicating, there's a lot of risk out there. But I already mentioned it, but the eurozone doesn't have any strange ways of calculating inflation. They have much more straightforward methodology. They don't have this strange financial services element. And their inflation is going to go sub 2 almost certainly. They're rolling off these gigantic numbers, don't have distortions. They're entering into a pretty significant contraction. So that is deflationary. So their picture is more clear. And that's why we wouldn't overfade the rally right now. I mean, we're cautious, but we wouldn't just sell everything because we think that we will get this summer rally.
And speaking of not selling everything, let's talk about some of the things you do like. You mentioned the money center banks, and I believe in particular, you like Morgan Stanley and Goldman Sachs, which, if there's going to be an uptick in deals and offerings, in theory, they would be poised to benefit from that. Is there more to your bull case? Are you looking for other sources of upside for them?
Well, yes, there's a nuance to it that I appreciate because I actually worked at Morgan Stanley, but worked on Wall Street. And when you're inside of it, what you realize is that an investment banking deal is not just good for the investment banking department. It's phenomenal for sales and trading because it generates a lot of activity. And if the salespeople allocate deals, then there's usually flow that comes back. And it's also positive for wealth management because they get deals and that gets credit to them. In fact, everybody was disappointed about Morgan Stanley's wealth management last quarter, but it was really because there was very few offerings. And then if we're right about the market going into the 5,500 to 6,000 range, that's also good for asset management, for the same reason that the Fed thinks inflation's going up, or the BLS, because AUM just rises with the market. So these large investment banks are the perfect bull market financial security.
Interesting. Jay, great to catch up with you as always. Appreciate it.
Great. Thanks, Julie.